Joining us now is SEI Chief Investment Officer Jim Smigiel. Jim, you talked earlier in the year about this wall of worry that the market had to climb. You even raised some concerns about private credit, I believe. We're now in Q4. How much worry is left for this market?
Well, there should be a lot more worry, I think, than what the market is actually showing us and that investors are really showing us. I put out my quarterly piece today, and the big theme is it's not about the volatility. It's about the fragility. And as markets get increasingly concentrated, like we're seeing today, whether it's NVIDIA approaching 8% of the S&P 500, whether it's tech at 35%, whether it's an AI theme, which, depending on how you calculate it, is about 43% market cap and accounts for about 75% of the price return since ChatGPT came out, that is a very concentrated market. And that adds fragility that investors, I think, particularly passive investors, need to be aware of. If you ask me today as an equity investor, what's the biggest macro event that we're all waiting for in the fourth quarter? Honestly, it's November 19th. It's NVIDIA earnings, because that's what is going to be able to move the market. So diversification is the answer, but fragility is our term for the fourth quarter, and I think it's something investors need to be more aware of.
So given that fragile state and the fact that I think economic policy is both different from historical norms right now, and this government shutdown threatens to make visibility tougher than usual, how should investors compensate for that?
Diversification is probably not the answer that they want to hear, but that is the answer. And that's diversification by global markets, that diversification by capitalization, diversification by factor, which means diversification into active management. It sounds as though I'm talking my book, and in some ways I am. But passive management in the S&P 500 is not the same thing as it was just a few years ago. You're not getting this broad-based beta that you used to get. And so diversification is really the only way, the tried and true way to protect yourself. And your point is a good one. And Steve Leisman, hats off to Steve. He's exactly right. I mean, the data and the quality of the data is not just a problem for policymakers, it's a problem for investors as well, right? If you're lost in the forest, not any map will do. You need the right one. And the data has just been wrong. We have 2 million jobs that have been wiped off the rolls, and that has influenced policy. So it's interesting times. Investors need to protect themselves with diversified portfolios.
You literally just took my question out of my mouth, and I was going to say, okay, Wall Street investor, data hamster wheel, how are you navigating it? What's your sense of the economy, and how does that feed back into asset classes?
Yeah, think about it not just from an asset class perspective, think about it from an economic regime perspective. Yeah. Do you still have inflation sensitivity in your portfolio? That's typically not a strategic holding that investors have. We're still bullish gold. It's run quite a bit. It's reaching an all-time high, like a lot of other asset classes are reaching all-time highs. But we think that's for good reason. Great hedge for geopolitical concerns. Also, supply and demand looks really favorable to us. We think investors are underallocated. Central banks remain underallocated. They're going to be big sources.
How should investors hold it?
We like it the direct metal, quite frankly. So we just have that as maybe even part of a broader commodities exposure, and just have that be your inflation-sensitive assets. We think it makes sense on a strategic basis.
Okay. Jim Smigiel, it's great to have you here on set. Thank you.
Thank you both.
With Major Average.